Hello and welcome to our PensionMan Insights Explainer. Today we're looking at mortgages in the wake of the Bank of England's recent interest rate increases. Big question here, why did the Bank of England increase interest rates?
Yeah, no, exactly. The reason it did so was because basically inflation is rising. So for decades the central banks were battling against unusually low inflation, and that's why they kept interest rates really, really low. But with the pandemic, with fuel costs, with supply chain disruptions, we've got to the situation where prices are rising quite quickly. It's not exactly clear what the Bank of England can do about it by raising rates, but since they've got their inflation targets, they've got to raise rates and continue doing so until inflation comes back under control.
So what difference does this make for people's mortgages?
Well, in the good old days, when the Bank of England raised rates, the building societies and the banks would raise their mortgage rates, within a matter of hours. Today, though, 74% of the residential mortgage market is fixed rate, and that rises to 96% when you consider the mortgages taken out since 2019. So basically, the market is a very different place to what it was, a few years ago, perhaps even a few decades ago. However, where the pressure does show is in new products. So, for example, last October, there were 130 two-year fixed-rate mortgages at less than 1%. Today, there's less than 10. So, although there's been no change in the cost of borrowing for most people in the short term, refinancing is almost certainly going to be more expensive.
So what about first-time buyers?
Right, well, actually, relatively speaking, they're in a much better situation, because when the pandemic struck back in March 2020, the banks were terrified of a tsunami of mortgage defaults as the economy collapsed. So they withdrew all their most attractive products, and in particular, they withdrew products that first-time buyers would have benefited from, the low deposit products. And to the extent that a year ago there were hardly any 95% mortgages around, whereas today there's thanks to the government's 5% deposit guarantee scheme, there are almost 250 95% mortgages around and almost 450 90% mortgages. So if you can get to that 10% deposit rather than 5% deposit, there is a much bigger choice. Added to which, because the wave of mortgage defaults didn't materialise, and at the same time we've all been involuntarily saving because thanks to lockdown there was nothing to spend our money on if we managed to stay employed, and furlough managed to keep people in the game, and working from home definitely kept people in the game. Banks have got tons of money to lend, and they're gradually sort of increasing the competition in the mortgage market. So they've been driving rates lower, even as expectations have risen that the Bank of England would raise its own rates.
Okay, so overall things haven't been as bad as you might expect.
No, definitely not, because basically from the perspective of a first-time buyer, for example, a year ago a typical 95% mortgage rate will be about 4.44%. Today, it's a record low 3.06%.
Wow.
Yeah. Okay, so our three takeaways from the current state of the mortgage market are: one, for sure, there'll be far fewer of the sexy sub 1% two-year fixed rate mortgages. Last October, there were 130. Today, there are only 10. But since more and more of us have got fixed rate mortgages, 74% of all mortgages are fixed rate at the moment, and that rises to 96% for mortgages agreed since 2019. The impact of the Bank of England's most recent rate hike will take quite a while to feed through. And the best news of all is for first-time buyers. Competition to lend to first-time buyers is now so intense that rates are still falling, despite the fact that the Bank of England has started hiking its own base rate. So the average two-year fixed rate mortgage for a 95% loan has just hit a record low of 3.06%, down from 4.4% just a year ago. So for now, at least, nothing much has changed. What happens going forward really depends on whether the Bank of England gets lucky on inflation and can stop raising rates before it does any real damage to the economy. So we hope you've found this useful. If you have, please like, subscribe, comment, tell your friends. You may also be interested in receiving our Friendly Money newsletter every few weeks, which you can sign up for on our website, which is www.pensionman.co.uk. But most of all, thank you for listening and take care out there.